when we announced the sale of Solar City to Tesla, I was lucky enough to exit at acquisition. It was Tesla, and I think probably about 6 to 8 months into time at Tesla that decision was made. So I get the luxury of saying I had no part in that decision. But the answer really is, Tesla had a very different vision for solar, as we can see based on the numbers today. And where we used to be when we sold Solar City to Tesla and where they ended up. And I think it's fair to say that Elon was not a supporter of the door-to-door sales channel as a concept and felt maybe that it was not brand representative of Tesla. Now, I think everybody listening to this, everybody watching it, and certainly the three of us would say, huge mistake.
What's up, everybody? This is Sam Taggart with another awesome, guys, this one's gonna be good. And this episode, we are gonna go into finance. And before I do that, guys, we got Door to Orcon coming up January 20th and 21st. So make sure you don't miss that. Some phenomenal speakers. And I've got two of the people that have been part of Door to Orcon in the past and will be there this year as big vendors. But not only that, but just like icons in this industry. And some of you guys would never even have heard these names, but I sure had. And when I heard I had the privilege to get these guys on the podcast, I was like, oh my gosh. First one was we have Jess Phillips, who was a former founder of Enium Capital Group, which was a finance company. And they, have now started Quativa, founder of Quativa, and he's the chief sales officer. He works heavily in the solar space and tech. He's worked in the finance space. They've worked in the commercial solar space. And if you haven't listened to our previous podcast we did a long time ago, go check out that one. But the big one that I was like, wait, I'm doing a podcast with Paul Steffen. This is going to be epic. And he is one of the founding members of GOODLEAP. And he's the chief business development officer. And, I remember the name Paul Steffen back when I was in solar and getting recruited into solar, as he had a very, very senior role in Solar City. And watching Hayes Barnard go over and start GOODLEAP with Paul and then kind of have that exodus and start this financial juggernaut doing over $1 billion a month, guys. Like, that's massive. We're going to talk like actual finance. Like, we're going to talk real numbers when it comes to interest rates and how to sell these solar loans and how to, what's going on with the market and how's this impacting sales reps to companies, to dealer fees, to, all these things that reps just don't get. Like, I'm telling you, you're out selling right now. You're like, oh, those stupid honey mongering, like finance companies, they're just, taking this 30% dealer fee and like take away that, you know what I mean? And I'm just like, guys, if you understand finance economics, what's happening with the feds, you're going to want to listen to this. And if you don't, this can be really eye-opening for you. So welcome to the show, Jess. Welcome to the show, Paul. Super excited to have you on the show.
Oh, thanks so much, man. I'm so glad to be here.
Well, first off, Paul, can I just ask, can I just say history day for solar? I'm sitting there at Solstice, VP of sales, and I get a phone call from John Frampton, who was under you guys. John Frampton was the VP of sales, or what was his title? President of sales?
Yeah, he was senior vice president.
Senior vice president, and your title was?
Executive vice president at Solar City.
At Solar City, guys. This was the juggernaut of sales. Like, it was like you had Sunrun or Vivint Solar at the time and Solar City were like the behemoths. And all of a sudden, Frampton's like, hey, everyone's done. Like, I want to know behind the scenes, like 1,600 sales reps. That's about right? Like, it was like.
On the door-to-door side, yeah. My team was 6,500 total.
So, guys, he's made 6,500 sales reps, and then Frampton was over 1,600 of those. And overnight, the 1,600 didn't have jobs. And that became like a feeding frenzy for recruiting, obviously. So I'm sitting there like, oh, cool, it's called Solar City people. But like, I'm curious behind the scenes real quick. I know that's not the main focus of the podcast, but I was just curious, like, what was going through your head? I mean, that had to have been a weird turn of events.
So the good news for me is when we announced the sale of Solar City to Tesla, I was lucky enough to exit at acquisition. it was Tesla, and I think probably about 6 to 8 months into time at Tesla that decision was made. So I get the luxury of saying I had no part in that decision, but the answer really is, Tesla had a very different vision for solar, as we can see based on the numbers today, and where we used to be when we sold Solar City to Tesla and where they ended up. And I think it's fair to say that Elon was not a supporter of the door-to-door sales channel as a concept, and felt maybe that it was not brand representative of Tesla. Now, I think everybody listening to this, everybody watching it, and certainly the three of us would say huge mistake, huge mistake.
I mean, you look at like Sunrun's numbers, you just look at the numbers that door-to-door brings to the solar industry and has since brought. I mean, we're talking back in like 2014, 2015, 2016 days. Think of how much the solar industry and door-to-door, and it's not just all one behemoth. Back then it was really big companies. Yeah. Then it's decentralized quite a bit into a lot of these dealers. But if you were to wrap it all together and say how many new solar projects go up on roofs per month from door-to-door, it is massive. And I'm sure you guys have similar numbers from GOODLEAP backing to kind of back that statement, I'm assuming.
Yeah, 100%. Yeah, I would venture to say about 70% of the business right now is being done from people that are busting their knuckles, knocking doors.
That's a cool statistic. I mean, guys, people that are funding $1 billion a month to say door-to-door does 70% of that volume, like that's big. That's big. So
Sam, I would add when we probably meet with 30 to 40 companies a day, solar sales dealerships. When they tell us that their business is originated mostly from door to door, our whole team naturally lights up differently. We know that they get results. We know that they have control of their business. So I would echo that it's the ones we get most excited about is the door to door companies, because they have control. They are consistent.
Love that. So big shout out to all the DDD people. We're going to be talking pretty high level. So Jess and I are here to just interpret kind of some of these big numbers and big words and just like turning it into how do we take this volatility in the market and what's driving it, and kind of diving into like what's happening with interest rates and home values and all the things changing and where things are going, and how do we capitalize on that, not just sit there and run from it. I've had reps that are like, well, how am I supposed to still sell when I have a 30% dealer fee and the 299 goes away or the 199 is not there? And I'm like, are you effing kidding me? First off, before we dive into all this stuff, when I got into solar, I was selling in Utah at $5.25 a watt. My average, so that was my per watt price. Then my interest rate that I was average selling was a 3.99. Like that's what I was pitching. So $5.25 a watt at $3.09 or 3.99% interest rate. So when you're listening to this and you've just started in this industry a year ago, just know like this is just anyway. So I just want to put that out there. Okay, so Jess, I'm turning over to you. You're
Yeah, I'd love to talk. It's funny, Sam, because we've in the past podcast talked about that too, and that's your experience is a great segue into my experience. Kind of triggered this where I was like, man, I don't think a lot of guys have seen this like you just talked about. They haven't lived in a world of having to sell a 399 or 499 and a 599. When I started, it was a 5.5%, 650 a watt, right? 13 years ago. We didn't even have financing 13 years ago. When we got our first loans, it changed our business forever. We had a 15-year loan, 5.5% interest, like you said, Sam, with Utah's power rates. I mean, but it changed our whole company. So financing is so powerful, and it still is today. And so that's really, I got to see this presentation from Dustin Manziel at GOODLEAP a couple of weeks ago. And when I saw it, it just made me think, man, I don't think a lot of people, people that have been in the industry for less than 4 or 5 years, they've really never seen anything like this. They haven't been through some of these waves. And really altogether, financing's been around for about 9 years for the solar industry. And we haven't seen it change this sharply, right? So we know it's changing. We know it's gone up. And so it's time to pivot and make adjustments. And like we've always done as an industry, this industry's seen a lot of headwinds and then all of a sudden some tailwinds and all this stuff. Everybody calls it the solar coaster for a reason. So we're in one of those right now. And so we just wanted to take the opportunity as Quativa. We thought, man, let's bring together some of the industry's best. Let's get the word out through Sam. I know you're a big proponent for educating everybody and leveling everybody up. And with Paul, I mean, you can argue he's probably the best voice for this. So Paul's with the GOODLEAP, we know that, but I think today he'll be the first to tell you he's really representing the solar finance industry. This is something where he wants, I mean, if other competitors of theirs aren't doing well, it actually hurts them too, because just like our industry, we never want to see another solar company go down. It scares homeowners and all that. And so he'll be here representing more so the finance industry and telling us what's going on, why are dealer fees going up and what to expect going forward. And like you said, Sam, love to translate some of that so it helps you as a sales dealer, sales rep, your mindset, and then what to actually say in the home. So we've seen this before, we've navigated before, want to be able to share that experience today. So that's why we brought Paul on. I mean, just incredible experience. One of the things that I want to also add about Paul that I think is important is Paul's been in a home selling solar. He started a solar company. He sold it for 9 figures. That was before Solar City, running huge sales forces, 6,500 people. So he's been where you've been. I'm sure Paul's knocked doors selling solar, just like me, right? Just like Sam. So we want to make sure first and foremost to respect you guys, know what you're doing, can relate to it. And that's why we wanted to bring this stuff to you guys so that, you know, all that work is multiplied with the education you guys can get today. So I'm going to turn over to Paul. He's got a short presentation for us, and then we'll follow it up and kind of translate that for how you guys can take advantage of it, you know, in the home.
Thanks, Jess. Yeah, again, so thankful to be here. And I'm one of those guys where I never listen when bankers talk, as I don't trust bankers. The good news is I'm a solar guy, and I come from the space. We built our first company in 2009. And as Jess mentioned it, yes, we sold that company to Solar City, and that's how we landed there. So my background is more heavily rooted in solar sales and solar operations than it is banking. I just so happen to also have about 10 years under my belt of finance. So I'm going to keep it very high level. I think the most important thing right now is we don't get lost in the weeds, and we provide a good understanding for what's happening in the space, why it's happening, and then try to translate it into the action for everybody that's listening to the podcast. I think that's the most valuable use of our time. So I'll share a couple slides that I think will be representative of what's happening and help people imprint on the data. Okay, you guys can see my screen, yes? You see GOODLEAP?
Yeah, and if you're listening to this, guys, I'll try to pipe in where you can't, obviously, you're driving or you're just listening to the audio version. We'll kind of dictate what we're showing. But obviously, if you're on YouTube or wherever seeing this, it's a much easier thing. So make sure to go to DDD Experts YouTube. If you guys want to see the slides, you'll be able to see them there.
Great. So just to, you guys don't need to know a ton about us. This isn't really about GOODLEAP, but I think it's important just to understand when you're focused on financing and you're focused on who is ultimately funding your loans. We all know that's the lifeblood of your business, is your pipeline, right? You get the deal. We all know it'd be great if everything got installed in a week. It doesn't. Sometimes it takes 2, 3, 4, 5 months, even longer. So understanding the risk associated with your pipeline is really, really important for the long-term longevity of your business. And so for us, we are very, very grateful. We're the newest entrants into the financing space, just 5 years old. Our financing business as a whole, we started in 2003. The solar portion of it, we started really in the tail end of 2017. So we're the newest in the space, but we came with a very unique methodology, and that methodology really was sales centric. Little things like when I was at Solar City and prior to that, when we did work with other financiers, they just never really understood what it was like to be in a customer's home and selling. The welcome call was a great example. Bankers love the welcome call. We all hate it. I can't tell you how many deals I lost because somebody on the other end of that phone said, "Are you sure you really want to do this?" So that was one of about 6 or 7 major items that we said, "Hey, we have to change this. Bankers don't understand this industry. We do. So let's fix it." But we've been very, very blessed. We're right now between 40 and 45% of the loan market today, and so that puts us larger than the other competitors in the space. So we feel good. We've got a good platform. We're well capitalized. We're a private company, no debt, no board. It's one of the 5 principles of the business, and we all come from this space. So just think, if you're listening to this call right now, you're passionate about what you do, if in the future you decided, hey, I'm going to go build a finance company, that's what we did. So that's kind of where we come from.
Wait, how do you get here? I guess my question is, obviously you're supplying the debt, but you don't have debt. Where do you get just a bunch of investors? Like I've always been wondering them, like, how do they come up with $1 billion that they're fronting and waiting forever to get their money back? Sorry, I don't mean to throw you off, but I'm like,
no, you're not throwing. No. It's a great question. So it's actually, like everything else, Sam, that we're going to talk about today, it's actually pretty simple. So in our space, all of the lenders have warehouse lines. So they're giant lines of credit. So we borrow money to fund the loans. Then we sell the loans to the end takeout. It's called a takeout or a takeout partner that ultimately is going to service the loan for the entirety until the customer pays it off. So when they buy that paper from us, we pay back the warehouse line. So we borrow money, we lend money, we pay the money back in a continual cycle.
Okay, I get it. Cool, moving on.
Great question. So Jess asked me earlier, he said, hey, one of the things I think the group would really benefit from is understanding why there's so much volatility in the market. Interest rates have moved so fast. They continue to change. There's a lot of misunderstanding for what's driving that and why. And I thought it was the best way for us to get started, right? Is it starts with inflation. As we know, if you can see, this is one of many articles that if you just Google inflation, what you'll see is we're experiencing right now a level of inflation that we have not seen for most of us in our lifetime. And the entity, the Federal Reserve, you'll hear us call it the Fed a lot. One of the tools that the Fed uses to drive inflation down or to slow inflation is the adjustment of interest rates. Okay, and so we're going to keep this high level. We won't go microeconomics. We'll stay macroeconomics. So why the Fed does that is an hour in itself. But the Fed uses the adjustment of the federal funds rate, which is the rate that banks charge each other, sort of the overnight. If Jess wants to borrow money from me, he's a bank, I'm a bank. I say, okay, great. Here's the money. Pay me back tomorrow. Here's how much interest you pay me for the one day. Generally speaking, high level, that's the federal funds rate. And so the Fed adjusts that to try to slow inflation down. So the key point here is what's happening now is something that we've never seen before. It is moving lightning fast. And all lenders in every space, not just solar, are just desperately trying to keep up with what the Fed is doing. Okay. So as I mentioned, interest rate hikes. That's how the Fed adjusts it. And as you can see from this article, there's a really nice timeline here that shows different times in history, whether it was 2015 through 2018, 2004 to 2006. You guys can see the different lines here. If you look at the far left, this is where we are today. And you can see that yellow line, how steep it is. This is the indicator that the Fed is raising interest rates faster and more aggressively than it has in any time in our recent history. Certainly any time that none of us have seen this in the solar space at all.
Yeah, Paul, so is this just impacting solar? Is it other industries? Like, what are you seeing?
Yeah, I mean, candidly, I wish it was just impacting one sector or one industry. It's not. It's interest rates. So anybody that borrows money for anything is being impacted by this. I think the best analog to track what's happening is mortgages. It's a very, very seasoned industry. And if you pay attention to what's happening in mortgage interest rates, it's a really good indicator of what's happening for everything. And I'll talk a little bit more about the everything part, but if we start just looking at mortgage, it's really very telling. So if you look at this graph, what you can see is pretty simple. Unfortunately for us, it is low at the left and high at the right. And that's really not what we want to be seeing. And so if you go back a year, you could get a 30-year fixed rate mortgage for under 3%. And so for those of us that have either bought homes in the past, refied our homes, those are great interest rates. Those were always, those are pretty low.
Yeah, but you talked to my dad. He's like, I remember in the 90s when you could, you were stoked when you get a 9% interest on a house.
That's right.
That's right. It's interesting to talk finance through with your parents. Go ask them about it.
Yeah. I remember my dad told me that in 87 when he moved here, he had like a 14% interest rate on it. home. That's why it was the American dream. It's super hard to get a home, you know?
Yeah, and really what you guys are talking about is the cyclical nature of what happens in our economy. The unique space, or the unique part for us, is we are in a space where, either because of our age of the space, the industry, the solar industry, solar finance industry, or our actual age as human beings, we may not have ever experienced that before. So it feels unique. We don't know it's a cycle, but it is very cyclical. And we are in one of those places right now where interest rates are rising in a cyclical fashion. And I'll show you some other data that will talk to that. But yeah, I think Sam, Jess, great talking points. If you speak to others that have been through this before, they'll say two things. One is, yep, you're in that cycle. And then the other one is, hey, 7%, it's not that bad. I remember when it was 15. I remember when it was 16. I remember when it was 18.
Yep.
So we won't get there. I don't think the Fed's going to go that crazy, but good to know. But now look at where we are today. If you look at the top right, so interest rates, if you just go back to March of this year, you could get a 30-year mortgage for under 4%, and you call it 3.25%. It's doubled. Where we are today, now you're looking at closer to somewhere between 7.25% and 7.5%. So the thought you should have is, since March of this year, call it 6 months, safe. In 6 months, interest rates have doubled. Yes.
Well, so put that in a house perspective. I think, a lot of these sales reps, they aren't going out and looking to buy a house. Yeah. But had they been house shopping back 8 months ago, they would say, okay, your mortgage, let's say on a $500,000 home, I don't know the exact numbers, but I'm just going to use dummy numbers. Yeah. It's like your mortgage is going to be $2,000. Now, for the same mortgage, the same $500,000 home, the amount that goes towards interest, now you're going to be spending $3,000 to $4,000 a month for the same house. You know what I mean? It's just like the monthly payment just went from $2,000 to $4,000, $3,500, and the home value is the same. That's what's crazy, is it's impacting that. So if I'm a sales guy, I'd be like, dude, you're probably going to stick in your house a lot longer, because the last thing you want to do is go get a new home at an 8% interest rate. So more longevity in the solar. That might be like a little plug to build. Hey, you're probably not moving all the time. There's going to be less people moving all the time. So might as well put solar on this house, because you're going to be here for a minute. So that might be a cool line you could play from the transactional, constant moving, constant, elements. So anyway, keep going.
Yeah, no, that's a great point. And I would add, Sam, right? We're all sales guys, so we can't help but sell.
Yeah.
I would add, right now, if you look at people's net disposable income, the amount of money that they have after they get their paycheck and pay taxes and do all that kind of stuff, so much more of it is being gobbled up now by interest, that their desire to save money is even more important, right? Yeah. In the past, we've all been there. You can show a customer maybe $20 a month savings, and they go, it's not enough, right? And you're like, hey, it's $20 is $20, and over time it grows. That $20 savings, people's opinion changes pretty drastically when they have less disposable income, and that $20 a month savings is food or diapers or baby formula. So the customer's desire to take advantage of savings through solar tends to grow in positions like this.
Next thing would be, if inflation's gone up by 9%, that means your gas, that means your utility, that means your phone, that means a lot of things. So, you talk about this, on this slide. So kind of talk to us about, my desire to save, but my desire for control might come in as a sales rep. And this is like such an urgency and such a reason to do solar now. So talk to us about kind of this concept of the consumer price index.
Yeah, I mean, you took the words right out of my mouth. It's what we're seeing in this increase in interest rates. Remember, it's coming as a result of inflation. Inflation is the cost of goods and services increasing, right? And in this case, at a very rapid pace. So outside of interest rates, just electricity as a whole is rising rapidly. Look at this graph. If you go all the way back to 2002, we're basically at the highest growth point in the last 20 years. Right? So consumers are paying more for electricity. They're paying more for gasoline. They're paying more for food. And so when you look at the cost of interest rate increases as they pay for solar, you can't look at it in a bubble, right? You look at it as compared to other things. We all know we used to, a year ago, you go out to eat or you buy gasoline or whatever it might be, you pay a certain price. Today, we all get a little shocked when the bill comes, or mean, you put $150 at the.
You go to McDonald's, I'm like, wow, I just spent like $45 at McDonald's. Like, what the heck?
Yeah, that's a litmus test. When Jess says an Egg McMuffin is now $6, we got a problem, right?
Yeah. But okay, if you're not watching this and you're just listening, go to YouTube and screenshot these slides, because this is a slideshow you can literally show a customer that is a little bit more of an engineer brain, financial brain. They're like, I don't want to do it right now. I'll wait until X. And I'm like, this would be really good selling lines or selling material to help build your case in a solar presentation. So if you're not watching, go check out the YouTube.
Yeah, and you can do stuff. Go ahead, Jess.
Yeah, another thing right there, Sam, to your point of like comparing from before, is like when we were selling solar on the doors, just getting our career started, you know, we were selling a 4% increase annual, right, on electricity. I mean, you've got a 15.8% annual increase. So yeah, along with the challenges of dealer fees and things, that's a powerful number. We all know when you plug that number in long term and you're selling on long-term savings, it's a pretty powerful number, and it's real. It's right here on the chart. So.
Yeah, and you know, the word of caution, the compliance guy in me is going to say, be cautious, right? We don't want to set unrealistic expectations for the consumer. That's where we are today. We can see where it is today. You know, what we portray to the consumers is always a long-term sort of running average, because it'll come back down. So always take that with a grain of salt. But Jess is 100% correct. The cost of goods, the cost of services are going up sharply for everything. And you can use that and your talk track with consumers, because they need to save more money. Savings are more important now than ever before. Again, it used to cost you $60 to fill your tank. It's now costing $125. And cool. Where's that $60 coming from?
And you would use the same, like, I bought my home in December of last year, luckily locking me in at a great interest rate. And so it's like, they can't change my interest as a fixed interest rate. They can't change my monthly payment. Like, they can't change it. So had I bought the same home with a different interest rate, you know, down the road, that sucks. But it's like having your utility bill, they're changing it. They're always changing it. Right now, you have the opportunity to say, I'm locking in that monthly payment price. Here it is.
Mm-hmm. Right? And then we all know this, right? We all want savings for the consumer, right? It's so good for consumers when we can come back and say, hey, look, if you do this, it costs you nothing out of pocket and you save. But you know, what you just touched on is really powerful as well, which is it's independence. It's even if it doesn't save you money, geez, even if it costs you $5 more, right? And we're always worried about, hey, how am I gonna, you know, with interest rates going up and payments going up, you know, I'm not gonna be able to sell as many homeowners as I used to be able to. You can, because the focus for the consumers was on savings before. Now it might be independence, right? It used to be only savings. Now it's, I just want to lock it in. I just don't want it to get worse.
Jess and I selling here in Utah, it wasn't savings ever. It wasn't like, oh, look, you get to pay $20 more to save the planet and to lock in your rate.
That's right.
That's it. That's right. It's only $20. You know what I mean? Like, that was how I'd have to present it. Not, you know, like you have to spend $50,000. Yeah. It's the long term.
We all pay for insurance, right? Some form or another, whether it's medical insurance, whether it's car insurance, whether it's life insurance, you pay a premium to lock something in to provide you security. Right? It's not a problem.
I think that's a huge point, Sam. I didn't think about even before when I saw this presentation is some listeners might be in markets where they were just hitting that cusp. Maybe you're in some Oklahoma or some Midwest state, right? That just started to see monthly payment be lower for solar with financing than the utility. And you're thinking it's finally going to work. We're $5 or $10 less. And now maybe dealer fees have put you a little bit in the other way. I just want to make sure you heard what Sam said. Every solar sale, at least I had, I'm guessing same with you, Sam, that I ever sold or anyone on my teams or anything, every single deal was the monthly payment for solar was actually higher by $5 to $25, $30. In Idaho, Colorado, Oregon, Utah, really low power bill rates. And so we sold all the time in this environment because it was all about the long-term savings to hedge against, you know, these big electricity increases. So yeah, like Paul said, it's 15.8% this year. We know it's not going to be that every year, but this is when customers are feeling it and believing in those rate increases more than ever before, because they're seeing it's big enough change. They're actually feeling it on their electric bill. So if you're in a market like that, know that you can still sell solar. That's how most of us cut our teeth selling solar. That's how almost every market has been until just the last couple of years that we're selling solar. It was really California and Arizona were basically the only markets you could sell solar in besides the Northeast. and have that savings be from day one. So know that that's another thing I want to make sure you guys hear as well, is that you can sell in this environment.
Well, here's with the changes happening so rapidly as well. Something to pay attention to is utility. You're running on a 12-month average, meaning you're going to pull the last 12 months of power bills and you're going to run a 12-month on their monthly payments. Let's fast forward 12 months and say, let's assume that the next 12 months, you're at this current utility price that's today, the inflated rate. So now we can run, your average monthly bill was 150, but at this current rate of the last month or two, it would have been at 170. So really, is there a $20 more a month? Or is it just the fact that I was looking at January, February, March of a year ago when we don't have inflation tacked in? You know what I mean? So you might even play the card of like, we're running off of usage and time of what's the past. Let's anticipate the future pricing and let's put that number in. You know what I mean? So that way, when they're looking at the two numbers side by side, you could play a little bit there in that regard if you wanted to. So anyway,
Totally agree.
Keep going, Paul. I didn't mean to cut you off.
I love it. No, educating the customer is key. Giving them options, making sure that they're part of that decision. It's all really, really important. So listen, the consumer price index, we talked a lot about energy because obviously it's near and dear to our heart. That's what we do with solar, but it's not just energy that's playing, that's growing as fast. So if you look at all of the items outside of food and energy, the things that we tend to use the most, same thing, 6.6%, everything's creeping up. Apparel, medical, shelter, you name it. Gas, we all know. We're all feeling the pain at the pump. But yeah, so continue to be on the lookout for those and understand that from a consumer's mindset, right? We all know this. You never shop for the consumer. You let them do the shopping. They are right now experiencing outside of you, outside of your pitch, outside of the things that you're sharing with them, the education that you're providing to them. They are experiencing massive fear, massive anxiety because everything is starting to cost more. So just understand that you don't have to use the pitch of 6 months ago or 8 months ago because the consumer is not the same consumer of 6 months ago.
Yes.
Yeah.
I just talked to a financial advisor. They sell life insurance and she was like, it's just 5 times harder right now because their answer is, I don't want to spend anything that seems excessive or not necessary. Because she's selling like different life insurance policies, different vehicles there. And I'm like, interesting. I don't think in solar I would have said the same thing. You're already spending money on utility. So now wouldn't you be more conscious of the $20 savings or whatever? You know what I mean? Like it's not an expendable thing that is excess, where she's now moving into other industry because she's seen such a slowdown. Real estate agents are seeing a slowdown and feeling the pinch. And so you're like, the cool part is if I'm in recruiting, I'm looking at even other industries that are seeing slowdown and pinches on things that they were selling that may have been luxuries. Now you're going to see the consumers start to be less in the luxury acquisition and more into the savings and hoarding type of mentalities, which only should strengthen the solar industry.
Yep, it's a great point. So Jess had great questions for me earlier. Jess, and there was another one. It escapes me. Hit me with something you think the audience will.
I mean, it's, you see it here. Is it impacting solar or everything else? I mean, you can see it on the chart.
Yeah, it is. I think.
Is it just solar though? Like, is it just? No, is it? No. I mean, you hit this, but is it impacting solar as well? Like, tell us like what you're seeing. I mean, that's our industry, right? There's also roofers listening to this as well. They use financing. They couple it with solar many times. So there's a lot of groups here that use financing. This
is the slide that I think tells the best story for those of us that sell solar, right? Just very simply put is, okay, so I understand what's happening, federal funds rate, all that stuff. I understand inflation, everything's going up, but what's happening with solar loans, right? Solar lenders are discontinuing the lower APR stuff, the lower interest rate stuff. Why? Why does that have to happen? So this is a really good slide, and I'll sort of share it with you. I think this is, if there's one time in this podcast, only one time that you're going to tune in, it's now. Like, listen to this part. This is really important. So if you go back and you look at where we were in 2018 or 2019, the cost of funds, that federal fund rate that we've been talking about, was at 2.5%. The lowest APR interest rate you could get on a solar was 2.99. So it's about 0.5% higher than the federal funds rate. And that makes sense, right? The federal funds rate is the rate that banks charge each other to borrow money. And they take that money and then they write a loan for lots of different things. In this case, it's solar. So there should be a spread. Well, then the federal funds rate dropped to 1.75%. The solar industry responded and said, hey, good news, the federal funds rate has dropped. We can provide lower APR stuff now. Then the solar loan availability dropped down to 2.49. Well, we got really lucky. And then all of a sudden the federal funds rate dropped down to 0.25. That's almost zero. You don't get lower than that. Solar industry responded with a 0.99% interest loan. Now, unfortunately, we're where we are today. We're in 2022. And as you can see from this graph, then the Fed has raised 4 times, 75 basis points or 0.75%, again and again, 50. They mixed it up, but basically between early, sort of Q1 and now, the federal funds rate has gone up 3 percentage points. So it went from 0.25 to 3.25. So pause there for a second. Go back in history. If you go back to 2018, 2019, federal funds rate was 2.5%, and the best interest rate you could get in solar was 2.99. Well, now that federal funds rate is 3/4 of a point higher. So if you just do the math, it's really, really easy. You say, well, it used to be 2.99, and now interest rates are 3/4 of a point above that. Should be selling 3.75. That should be the lowest interest rate loan I can get, right? Or another way to look at it is in 2021, and when we had that 0.25% federal funds rate, you could get a solar loan of 0.99. Great. It's gone up 3% now, 3 percentage points. So you just add the 3 percentage points to the solar loan. They move in lockstep with each other. So the right interest rate to be sold today is 3.99. Very simple. Now, I know that's a scary, I'm going to be very controversial for a second. Okay. This will be very scary. You guys will probably won't even believe me. Dealer fees. Why do we have dealer fees? Do we like dealer fees? Do we hate dealer fees? I hate dealer fees, right? This is the controversial moment. This is where everybody shakes
from the owner of GOODLEAP, everyone. You heard it firsthand.
Hate them. Hate them, hate them, hate them, hate them. We should not have dealer fees in this industry, period, pure and simple. And I'll tell you why, and I'll explain. By the way, dealer fees is not where we make money. And this is the thing that most people don't understand. And then we start getting into, maybe we'll come back and we'll do finance 201 instead of finance 101. And we'll talk about loans and dealer fees and how it gets made up and those sorts of things. But the important thing to know is what we want is as finance companies is the consumer to get a fair and accurate deal. We want the consumer to win. We want you to win as well. The way that you win is you make sure that the consumer pays the right amount of money for their loan to fair trade, and you're selling the right interest rate. The problem that we have today, because our industry is so immature, and I don't mean the people, I just mean solar finance is young, right?
Yeah, you have people showing a maturity of 22 years paying on a 25-year loan and still being accurate, or still being up to date, still being in that house.
Absolutely. I think this is the way to look at it. And I get it. If what I'm accustomed to selling, if what the lenders offer, right? Because part of this is a lender problem. If the lender is offering a 1.49% interest rate and they should only be offering a 3.99, why wouldn't I take advantage of that? Of course we expect you to. Just understand that from an economics standpoint, the only thing that can move, if the Fed raises rates like they have, the only thing that can move is the interest rate has to move or the dealer fees have to move. So one of those two things has to move.
Let me explain dealer fees in a different light. Okay. You go get a house and you talk to a lender and you say, I want an interest rate of X. And they're like, okay, we got you here. They're like, do you want to buy down your interest rate? And they will let you pay more upfront as an origination fee to get a lower long-term interest rate. So a lot of times, like, they call them dealer fees here. In the mortgage industry, it's origination costs, or they'll call it buy down points. And this is a common term. I think a lot of people that have never really dealt with finance have understood. They're going in there selling pest control and then they go sell solar or whatever, or whatever that is. And I'm like, guys, you can buy down with a higher fee up front to get a lower interest rate. That's just in common finance. So keep going.
You nailed it. No, Sam, so good that you nailed it. Simply put, what's the right interest rate that a consumer should be getting today based on everything that we've talked about? 3.99 is the minimum, period. That's it. Okay. As you very astutely brought up, but what happens when somebody wants to sell below 3.99? There's a fee associated with it. No different than mortgage or anything else, where someone has to pay money to buy that rate down to a level below where it should be. That's exactly the way dealer fees work in our industry. So think about it a different way. Is if your dealer fee on a 0.99, I'll make up a dealer fee on a 0.99, we'll call it a 25% dealer fee, just for giggles, okay? If now interest rates have gone up to 3.99, right? Based on that federal funds, the dealer fee associated with that 3.99 should be the same, 25. Because all you're doing is taking the amount that the Fed has raised rates and adding it to the APR. Now, if you choose not to do that, and instead you say, no, I want to stick with the 2.99 or the 1.99, your dealer fees have to go up. It's the only way. Now, remember, we don't want your dealer fees to go up. We don't like dealer fees. Dealer fees are, and I want to make sure everybody's clear on this, because there'll be a time when you'll say, well, what do you want us to do? What's the right thing to do for the industry? It's to charge the consumer the right APR with the lowest amount of dealer fees, because dealer fees over time are going to create more regulation in our space, period. No one likes consumers to pay fees. If you look at any attorney general out there, if you look at any consumer protection organization, anyone who's required to pay fees in order to achieve goods or a service will, at some point in the trajectory of that space, at some point, someone will start turning over rocks and say, hey, these fees seem too high. And so we want to be very good bastions of this industry. And this is the reason why I say I hate dealer fees. What's the right interest rate? Listen, if a mortgage, which is one of the most secure forms of borrowing and lending, if a mortgage is at 7.25%, what should a solar loan be?
Higher than that.
More than 7.25%, right? Right. So then you start getting into the 8.99s, the 9.99s, the 10.99s based on risk, but no fees. That's the ideal place to be. However, we still want to provide savings to consumers whenever possible, but just know that this is a decision that you make on the sales side. What am I going to offer the consumer? Is it a lower APR with a higher fee structure, or is it the right APR with a lower fee structure? We will always prefer the higher APR with the lower fee structure. The economics for us are the same, just to be clear. We don't make more money or less money. It is the right thing for the consumer to protect them so we don't have over-regulation at some point in the future.
Well, here's what's funny. And I don't know, it's a training issue. This is the reality. It's a training issue in our industry where some dude trained another dude that trained another dude and trained another dude, that the lowest interest rate is the one we pick every time.
That's right.
Where in reality, I used to, when I first started, nobody ever trained me in solar, so I kind of took a different approach. I remember buying a fourplex, and then I bought another fourplex. Well, one fourplex, and they're the same, almost the same price, almost the same fourplex. One I put on a 30-year mortgage. The other one I put on a 15-year mortgage with a lower interest rate. And, and I ran numbers, and I was like, okay, which one's going to be better for me, right? And I realized if I want to pay them off, I could pay. It was better for me to do the higher interest on a 30-year and pay it off in 15, and looking at the fees that were associated with me getting a lower interest rate. And I took the origination fee and I did a big spreadsheet, and I go to my loan guy. He's like, wow, you're smarter than I thought you were. Because I broke it down for him. And I just said, hey, can I pay down more principal? He's like, yeah, there's no early payoff. And then I got into solar shortly after this. And I was like, I understand finance. And so I'd go to the homeowners, and I like to sell in rich neighborhoods where people are a little bit more educated. And I would sit down with two options, and I'd say, so how long do you want to be paying on this thing? And they're like, well, not that long. So then what makes more sense? A high fee that they, no matter what, have to pay, or no fee and they just pay it off sooner?
Yes.
And so you think about like the difference of a 25% or 35% dealer fee on a $30,000 loan. That's a high fee. And if I can give it to them at really no fee, but let them dictate when they get to pay that thing off and save money on the interest, there's a much better proposition for a homeowner. But most people aren't really stuck, especially right now when I'm thinking I'm selling, and they know you go to the bank right now, you're going to get an 8% interest rate for your house on a riskier, non-secured. Like, it's not like a GoodLeap is running to people's homes, ripping panels off, storing them over at a warehouse.
Right.
And I'd say it like that. I'd be like, I hate, and Paul, tell me if I'm compliance or I'm in trouble by saying this.
Right.
Like, correct me, but I would sit there with the homeowner and be like, shh, here's a little secret. If you just shit hit the fan and didn't pay your solar payment, I don't know how the finance company is going to come repo your solar panels. Where your car is as collateral and goes into resale, your house is collateral, they can foreclose on it and resell. I honestly don't know how they're going to resell your solar panels off your roof. And so I would tell the customer, I'd be like, I'm not saying do this because it's completely unethical, but at the end of the day, this is an unsecured, meaning it costs more for capital because there's higher risk to the bank to give you this amazing deal on money. Because what's your credit card that's unsecured? 16%, bro. And be like, luckily I'm not 16%. So anything better than 16%. And then I'd be like, I'll do you one better. What's the interest rate on your electricity payment?
Mm-hmm.
And they'd be like, what do you mean I'm not paying interest on your electricity payment? I'd be like, no, how much of your money do you get back from your electricity that they put back in your pocket? Well, none of it. So 100% interest rate you're currently paying, 16% on your credit card. So if I'm at 8, you should be stoked, right?
It's a great pitch. It's great. You nailed it.
Yeah, and all of a sudden what I did is I seeded 100, I seeded 16, I seeded where interest rates are going, and now all of a sudden they're not thinking 2%. Like, the problem is you're the only one that knew that you sold a 2% in the past.
Yes.
Salespeople, you're the only one that knew that.
Yeah, you nailed it.
No one else knows that. You go to a homeowner and you say 100%, 16, and 8, they're stoked.
Yeah. Yeah, you know what's really interesting, Sam, is if you look at outside of our industry, if you look at HVAC, or HVAC is it's a much more seasoned vertical than solar. Do you know what? And the same sort of thing. It's you pay, they install it. Nobody's going to come repo your HVAC unit, right? Do you know what the typical dealer fee for HVAC is? 0. You know what the typical interest rate is for HVAC? Yeah, it's between 9 and 10%. There's no difference here between the two spaces. You know what the difference is? HVAC is a need, not a want. Your HVAC breaks, your air conditioning breaks in the middle of summer. There's not a lot of negotiation there. You're willing to pay what you need to pay. And so they've never had dealer fees. They charge an appropriate interest rate based on that asset. Solar is a want, is a want more than it is a need. So it needs to be sold more. And so you need to create that excitement for the consumer, and you need to create savings. That's the difference between the two, but we're talking about financing, right? So in the world of finance, what should be happening, a 0% dealer fee, 10-ish% interest rate, that's the right product for consumers. You get to make the decision now, hey, what's that teeter-totter effect of APR and fee now? But if you go into it every time saying, I have to have the 199 and I have to pay these exorbitant dealer fees, candidly, you're picking the wrong interest rate.
I think you're picking the wrong.
And the consumer doesn't expect it. The consumer is seeing higher interest rates in everything. They know the mortgage is 7%. There's no way that they expect solar to be a 299 or even a 399. It's unfortunately, we are breeding that. And I think we need to change a little bit. And I think that's where we get very, very healthy as an industry. And again, I've been in this space since 2009. So I bleed solar. I want you guys to be wildly successful. And I was a solar installer before I was a solar financier, right? So that's where I'm coming from. I want you guys to be wildly successful. The right thing to do is to charge lower dealer fees and a higher APR. You don't have to, but just understand that that's where the dealer fees are coming, and they're not going in our pocket. And again, we can talk about how that actually works. Our margins stay the same whether you pick a 10% interest rate, no dealer fees, or a 2% and much higher dealer fees. It doesn't impact us one way or another.
I think people also need to see solar from I'm selling a financial product that's, substituting their power bill. I'm not selling a PPA. Like when you're talking finance, like people that were selling in these PPA markets, and PPAs are a whole different conversation, but it's like I'm at 10 cents a watt. I'm going to sell you a 9-cent PPA. Cool. Like that, you know what I mean? It's like a savings per electricity unit. With solar, like, you know, when you're selling on monthly payments, you're like, no, we're not buying. Like, I didn't buy my house based on monthly payment. I bought my house on what is my resale value, buying high, buying low. What's my, you know what I mean? Like, what can I get the best deal on a good loan? You know, can I get a good loan? I shop the loans, and I buy the house. Like, whether it was $7,000 or $8,000 mortgage payment, like that all came down to me negotiating on the loan a little bit, not so much buying the home. But I think like people, they try to sell this as like a alarm where it's like, hey, you're paying ADT $50 a month. What if I could do it for $45? And I'm like, guys, we're selling a new thing on your house, like a tangible thing, not like a PPA or a monthly service. And I think the more that we can see it like a financial product and or actual physical product that just happens to be around what you pay, I'm trying to make this really easy. My favorite line that I would use selling, here's another fun one. I'd be like, hey, you know, how long did you do your mortgage? Would you do cash, 15-year or 30-year? And they're like, 30 years. Most people say, right? Like, holy crap, do you plan on being here for 30 years? And they're always like, well, I don't know. Be like, most people are in the home for like 5 to 7 years. So like, if I could, I would have called your bank and I would have been like, hey, you forgot to add the solar. You forgot. And I'd wrap it right in with them. And their interest rate would be whatever your interest rate would be. Because when the next person comes and buys your house, do you think they're going to be like, I'm going to buy the house, but not the solar and not the fireplace and not the deck? We're going to sub-finance those out to different finance companies just for the halibut, shop different interest rates. No, when they come buy your house, they're going to get the whole kit caboodle, right? They're going to wrap it into a new mortgage. And if they were to do it right now, to get 8%, right? Okay, so let's just think about that. So, and I bring in this whole like, if I could, I'd call your bank. So what we do is 25 years because we assume most homeowners would be in there probably about 5 years by the time we knock on their door and get it set up. Some more, some less, like it's fine. But I try to mirror exactly where you're at with your mortgage so they kind of end towards the same time.
Smart.
And Sam, I wanted to throw in, I think that was one of the biggest points that triggered me to say, let's get this out to the public, was what you guys just talked about. Most of us are selling to people that are older than us, that have bought multiple homes. They understand these concepts. You can drive down the freeway and you can see the interest rates, 6.9% or whatever's in the billboard right now, right? In almost any market you go to. So unless you're under a rock, people know interest rates are that high. And so I think a lot of us are making mistakes walking into a home and saying, oh, I can get you a 3 or 4% rate. They're like blown away with that. They're almost thinking there's a catch. It doesn't make sense to them. I think we don't realize that because a lot of us haven't bought a home, or we haven't been through this multiple times like they have. That's why I love the story of Sam, you telling your dad, your dad's talked about interest rates being a different cycle. Those are our customers and they understand these cycles. So I really like, a lot of this comes down to, if you don't want to lose commissions, because it's got to come from somewhere, you'll have to learn how to start selling more on the long-term savings and selling on these dealer fees that are lower, but interest rates are higher. Learning how to sell the 499 and the 599 is probably the most important part of your business right now if you want to keep your commissions where they're at. Otherwise, you'll also have to participate on everything tightening up. So that's why Sam and I like referencing back in the day when we sold those rates, and when maybe the monthly payment isn't quite the same savings or it's even higher, it does not mean you can't sell solar. It's about long-term savings, locking in that rate. And so if you focus more on that and get away from the other style, you're going to serve your customers better. You're going to be able to keep your commissions similar, and everybody's going to win.
Here's another plug on that. If the inflation is going up by 9-10%, it'd be like the cost of panels. If you want to get solar today, it's 30 grand. If it's going up by 10%, it's 33 grand. It's going up another 10%, it's 36 grand. You know what I mean? It's like, cool, you could wait, but it's only getting more expensive. You know what I mean? I would focus, instead of interest rates, I would be like, the cost of materials, goods, labor, everything is going up. So why wait until it's more expensive when you could buy now as it goes up and you got it? You know what I mean? I focus on that inflation more than I'd say interest rates going up. I just be like, this is what it is. How cool we get this such a good interest rate for what we're getting. It's not 16% on unsecured. That's what's super nice.
Yeah. No, there's a great call to action right now. And so I think where I would try to drive the point home for the team is interest rates are going to continue to rise. The Fed's going to meet again on November 2nd, and then they're going to meet one more time before the end of the year. They've already signaled that they're going to raise again. So bad news, interest rates are going to continue to rise, or dealer fees are going to continue to go up. You get to pick which one you choose. And it's gonna be pretty material. If you want to get out in front of it, candidly, if it were me, if you were on my sales team back in the day, I'd be telling you right now, 4.99 is probably the right interest rate to get comfortable selling for the foreseeable future. You can probably get away with 3.99 and with more fees. But remember, 4.99 is still fantastic. Customers are paying 7% for mortgages. If you can get that up to 5.99, 6.99, hey, if you just match where mortgage interest rates are with a much lower fee, you're in a great position. But that's the challenge for you as a salesperson, right? Are you wrapped up here thinking I can't sell an interest rate above X? I'm worried about the guy that comes and knocks behind me. Look, we all know that there's a difference in the total amount financed, right? Based on those fees. We know that. So if the guy that comes and knocks behind you is selling a 2.99, you're worried about selling a 5.99, you prep the customer. Hey, there's some guys out here that are going to charge you a ton of fees. They're not going to disclose them to you, but there's going to be a ton of fees in there. I want to get you the right product for you. Sam, great pitch. How long are you going to be in the home? Right? Am I going to give you a 2.99 for 25 years if you're going to be in the home for 5 years? No, I'm going to give you a 9.99 with no fees. I'm going to give you a lower, and then the new homeowner is going to have no problem picking up the cost of solar lumped into the sale price. I mean, we all know this. You understand the needs of your consumer. That's how you get more sales. That's how you get more yeses. That's how you get more referrals. Lastly, at Solar City, we got up to about 40% of our business was coming in from referrals. So this was something that we really, really drove home. And we had the best salespeople. You worked for us at Solar City. I mean, you are hands down one of the best salespeople on the planet. Not limited to you guys, but man, I worked really closely with you. You guys did great here. If you sell a consumer right now $2.99, and they give you their friend or their family member and they share that information and interest rates have gone up, then they come to you and you can only offer them a 3.99 because the 2.99 has gone away, right? Or the 1.99 has gone away. It's a lot harder to close that deal. They might think that you're increasing the price because they don't understand those dynamics. If you get out in front of it and get everybody right now to 4.99, your referral rate will be higher and your close rate on those referrals will be higher. Go ahead, Sam.
Well, I'll put on that too. If somebody calls me and is like, hey, how much was your solar? I'm not going to be like, it was a 2.99. I'm going to say it was $36,000.
Right.
And if they're like, wow, mine was 65,000, I'm like, what? Or like, oh, mine was only 24,000. Like, obviously you have kilowatt size, right? And you can prep them on that. But when they put two proposals side by side, a lot of times the consumer looks at the total cost. And when the total cost is less, they're gonna be like, well, this guy's cheaper. And you can, you don't play on the monthlies, you just play on this guy's cheaper. And I like selling that angle. I like selling the angle of, hey, I'm not the most expensive because some of these guys are going to be $10,000 more, but that's just the fee. So I'm just like, I'm playing psychologically on people selling on those low interest rates and being like, man, do you want to spend 10,000? You're only going to be here for 4 years, 5 years. Like, why would you spend an extra $10,000, you dink? And I would leverage that to close higher ratios, and my customers always love me. So I kind of want to wrap up. Obviously, thank you so much for this, and obviously we're going to see you guys in January. I'm curious to see what even happens between these two next meetups that they have on interest rates. But guys, if you're listening to this, I get nothing for this. Like, it's not like I get anything. I care more about this industry as a whole, and I like that Paul kind of took a neutral approach. Obviously, GOODLEAP is a phenomenal bank that is like you said, 40 to 50% of the market share right now. And I think that I watch company owners, I watch sales reps blaming these finance companies as if they're like the bad guys. And I'm like, these guys are so creative that they came up with a way that we can now get solar at a really good way. Anybody that sold in California 10 years ago, they're selling cash price. They're selling, got to go to the bank and figure out a home equity line. You know what I mean? Like, I'm grateful for innovation of financing companies like you that have now, with a couple of clicks of a button, I can get solar, where before you're mailing in credit applications, you're in like a whole world, like you, and I just want to say thank you. And anybody listening to this, guys, like, these are the innovators, these are the people, like even Quativa, that have built systems and apps and integrations to make this so seamless, where they've made it feel like it's one solid sales cycle, to where you can same day close. When I got into solar, it was impossible to close within 48 hours. There was no way you could do that. And so, it's just those that haven't seen it don't know, and they're 6 months new or whatever. You don't know what you have until you don't have it. And so just be grateful that these guys are on the cutting edge. They're in the meetings with the big dogs every day, asking like the Fed changes, knowing the meeting dates. These guys are paying attention to it, and they're bigger drivers of this industry than you guys think. So thank you for being on the DDD podcast, and we look forward to getting the feedback. So if you guys got value to this, share this with everybody in your office. Like, everybody in your office needs to watch this. Like, it's not like one of those things like, oh, that was a cool podcast episode. This is one, like, if you sell solar, make sure that everybody in your office sees this, because it's really informative on what's going on, and it's important that everybody knows. So share this with everybody you know in solar, and we'll keep it on, guys. Keep it up.
Thanks, guys.
Thanks,
See
Paul.